Hello my dear future chart accountants, welcome to the discussion on Revision Premier League Day 5 on FR. Can you please confirm that my voice is clearly audible and PPT is visible? Okay, good. So now let us move into the next segment remaining. Today topic agenda is in the financial instruments. We have to understand derecognition, hedge accounting, and then we go for Ind AS 115 and Ind AS 116. Both old syllabus students and new syllabus students can join. For new syllabus students, it is more important because full-fledged question comes. For old syllabus students, Ind AS 115, 116, you can just get an idea. You don't get full-fledged questions, but you need to be aware of it, what is happening in the market. So for that purpose, this will be a good revision part of it. So now let us go into the segment directly, that is on financial instruments. We discussed what do you mean by financial instruments, classification of financial asset, financial liabilities, recognition, subsequent recognition. Now we'll go for derecognition part. Derecognition means when you take out from your books of accounts. So financial asset, one, when there is expiry of right to receive. When that can happen, you have a sundry debtor, you receive the money. You no longer have the right to receive, or he gives you bill receivable, or you give him discount, or you write it off telling that he will not be able to pay the money. So when the right to receive expires, then it will be taken out from the books. This is interesting. You transfer the right to receive. The right to receive is there with you, but it is transferred. Typical example, bill receivable, discounted. So you have bill receivable, but you transferred. But if in this case, for you to derecognize, a transfer is not sufficient. One more point is important. It should qualify. Qualify means substantial risk and rewards should be transferred. So it is not just a transfer, a substantial risk and reward should be a transfer. This I would like to give an example of difference between factoring with recourse and factoring without recourse. Factoring with recourse means once you transfer the right to receive, in case the factor is not able to collect, he will pass on the loss to you. So, have you transferred the substantial risk and reward? The answer is no, because in case he is not able to collect, you will have to face the consequences. So, that does not qualify for transfer. That does not qualify for derecognition. Then how do you treat the amount received from the factor? Till it is final settlement, you will show as an advance. You will show it as an advance. Once it is finally settled, your debtor will be there, advance will be there. Once everything is settled, you set it off, so that ultimate asset and liability is derecognized. Now, in case it is factoring without recourse. Factoring without recourse means whether he can collect or he cannot collect, your payment, your collection is assured. So it qualifies for substantial transfer of risk and rewards. Therefore, it qualifies for derecognition. So factoring with recourse, you don't recognize the asset, but factoring without recourse or factoring with recourse, you will derecognize the assets. Factoring examples I told you. Now, financial liabilities, when discharged, when you make a payment to your creditor, when you repay your loan, it is discharged. What is important is this portion, which is modification, extinguishment accounting. So, some of you are asking yesterday also, when you take a loan, convertible debenture or non-convertible debenture, if market rate changes, should we make a change in our books? Generally, no. That is, amortized cost basis not required. But even under amortized cost basis, this modification may have an impact. So when does this modification apply? Whenever they say the difference is more than 10%. That is when it is called as material, and when it is material, modification applies. If it is less than 10%, it is not material, modification don't apply. Now the question comes, how do you compute this percentage? Then we can compare whether more than 10 or less than 10. The computation comes by the present value of modified cash flows at old rate and compare it with the carrying amount. You have one book value, amortized cost. That part you compare it with new cash flow, modified cash flow, but the discounting rate should be old rate. You understand, right? New cash flow, modified cash flow, but the discounting rate is the old rate. You get one present value, compare it with the carrying amount. If the difference is more than 10%, then it is material. Extinguishment accounting applies. If the difference is less than 10%, it is not material. Extinguishment accounting don't apply. Now, if materiality applies, what is that extinguishment accounting? Extinguishment accounting means we have to account existing carrying amount is replaced by new loan. Modification, material, extinguishment accounting. The existing loan is repaid or replaced by new loan. But when new loan you're replacing, don't use the present value what you calculated. The present value will be new. What new value? It will be modified cash flow and the new rate. So when you consider modified cash flow but the old rate, it is only for the purpose of assessing materiality. Whereas if you go for extinguishment accounting, you have to account for new amount, which is new cash flow as well as new discounting rate. So old cash flow, old discounting rate is carrying amount. New cash flow, new discounting rate is new carrying amount. Or new cash flow but old discounting rate is only for the purpose of calculating the materiality concept. So to understand this concept, let us do a problem. Question number 3. Please read. On January 1st, 2010, Preet Limited issued 10-year bonds for 10 lakh, bearing interest at 10%, payable annually on 31st of December each year. The bonds are redeemable on 31st of December 2019 for rupees 10 lakhs. Okay, let me ask you one basic question. Can you tell me what is the time period here? You have issued on 1st Jan 2010 and redeemable on 31st December 2019. Can you tell me whether it is, what is the time period now? From 1st Jan to 31st December. Can you tell me what is the time period in this case? What is the time contract period, time horizon of the bond? Okay. You might be calculating, but simpler answer is there. Question only mentioned it. They have mentioned a 10-year bond. So why do you need to worry about calculating it? You can, for the purpose of extra confirmation, but when you read the problem, read it carefully, because many of your silly mistakes would have been because of these things. Question itself has the answer. You will realize it later. I told you why. Examination is operation theater. Only when you come out of the exam hall, when the anesthesia, question paper, pain starts reducing, you start realizing your mistakes. Anyway, so only request is, when you read the question, read it thoroughly. Don't read too fast. Reading the question slowly will make your answer effective and efficient. If you are in a hurry to read your questions, you are bound to do mistakes in exams. Don't read the question multiple times. That is a wastage of time. But when you read slowly, but read effectively, correctly. Okay, let us go further. The bonds redeemable on December, no cost of fees is incurred. Effective interest rate is therefore 10%. So this interest also 10%, effective interest also 10% because no cost, no transaction cost. On 1st January 2015, Preet Limited and the bondholders agreed to modification in accordance with terms extended to 31st December 2021. There is an extension. Interest payments are reduced to 5% per annum. Bonds are redeemable on December 2021 for 15 lakh. It was supposed to be redeemed at 10 lakh. Now 15 lakh. See, there are modifications happening. But should you account for this modification? Depends whether it is a material impact. Let us come to that aspect. Legal and other fees. 1 lakh are incurred. Legal and other fees. Illegal fees? Okay, anyway, other fees. Preet Limited determines that the market rate on 1st January for borrowings on similar term is 11%. Analyze whether the extinguishment accounting will apply or not as per Ind AS. If yes, determine the fair value of the modified liability and compute the gain or loss on modification. They have given the discounting factor for 10% as well as for 11%. So what is our first target? You have to compute whether the modification is material or not. For that purpose, you have to compare carrying amount versus the new cash flow discounted at old discounting rate. New cash flow discounted at old discounting rate. Now, carrying amount, my dear friends. Okay, now carrying amount, my dear friends. Can you tell me how much is the carrying amount? Have they given carrying amount in the problem? Have they given the carrying amount in the problem? Or should we compute? Have they given carrying amount? Or should we compute? Because the changes, modifications are happening on 1st January 2015. The bonds were issued 2010. So 5 years over. 5 years are completed. Should we need to compute or have they given? Okay. Some of you are telling we need to compute, but the answer is it is given. 10 lakh itself is carrying amount. 10 lakh was the carrying amount on 1st Jan 2010. But it will be the carrying amount on 1st Jan 2015 as well. Why? Because the coupon rate is 10%, effective interest rate also 10%, which means what coupon you add is 10%, and what is the financial charges you add is 10%, and the cash flow coupon what you subtract is also 10%. 10 lakh plus 10% on the account of financial charges being effective interest rate minus coupon, which is again 10%. Therefore the effective interest rate and coupon rate both are same here. So we need not compute the carrying amount separately. We can directly go for carrying amount of 10 lakhs. I hope people don't have any confusion there. Some of you are telling EIR equal to coupon rate. You are right. Financial charges equal to interest paid. You are right. Yes, all these are the interpretations in this case. Okay, let's go further. So now what we should do? We should calculate the materiality. For that purpose, we will go for new cash flow, and in the new cash flow, we will compare the old discounting rate. So what are the new cash flow? New cash flow is coupon rate of 5%. Remaining year 7 years. So 10 lakh into 5%. And what is the market rate now? Not market rate now, old rate. Old rate is 10%. Old rate is 10%, therefore 50,000, that discounting rate they have given the question itself. You see 10%, you can add all these, this also they have given, annuity factor also they have given, we can make use of that number directly. And principal repayment redemption amount, that present value repayable after 7 years 15 lakh, last year discounting factor, that is a present value. And not only this, apart from interest payment, principal payment, even you pay transaction charges, that also you consider it 1 lakh. One second. So you take not only interest payment, principal payment, you also take the transaction cost, that is the new amount but discounted at old rate 11 lakh 13. So 10 lakh to 11 lakh 13, if I compare, difference is 1 lakh 13 158, and divide by 10 lakh means it is 11.32%, more than 10%, therefore extinguishment accounting applies. And what do you mean by extinguishment accounting? Carrying amount should be replaced by new amount. And how do you calculate new amount? New cash flow compared with new discounting rate. That present value, what do you get? Compare with the carrying amount. The difference will go to P&L account. In this case, let's recalculate. Same calculations will apply. That is 50,000 as the coupon payment. But discounting rate was at 10% earlier. Now discounting rate will be at 11%. The interest rate only changes. Annuity factor only changes. Other things remain same. This 15 lakh is same. But this was 0.513 at 10%. Now you will take 0.481658. Then you take transaction cost again. So total comes to 10 lakh 58. And what is the carrying amount? Carrying amount is 10 lakh. And new amount what we calculated is 10 lakh 58. And the differential amount will be transferred to P&L. Therefore, now onwards you will take 10 lakh 58. So in this case, effective interest rate is equal to coupon rate, transactions at fair value, the initial recognition 10 lakhs only. Yes, you are right. That is the situation in this problem. You are right. Okay, so this is the accounting for modification. Don't spend time in writing it down. Take a screenshot of this, and as usual, I will share this solution in the Telegram channel at a later point in the day. So don't worry about writing it down. Get your concepts clarified. Joint is very simple. Existing loan amount is 10 lakh is there. So you debit loan 10 lakh. Loss on modification 58,097 to new loan 10 lakh 58,097. Old loan 10 lakh. Loss on modification 58,097 to new loan 10 lakh 58,097. That's all the journal entry. No other journal entry you can expect. That's all. Very simple. The old loan is derecognized, new loan is recognized, and difference is transferred to P&L account, loss or profit on modification. In this case, loss on modification. What will be the transaction cost subsequently? That will be subtracted. From this 10 lakh 58,097, the transaction cost of 1 lakh is subtracted. That is always the case, my dear friend. Whatever is the value of the loan, from that loan, the transaction cost is subtracted. Be it debenture, loan, anything. From the amount of loan once recognized, in this case 10 lakh 58,097, the payment of 1 lakh will happen, subtracted. That will not go to P&L account. Okay, hope this is fine. Shall we go to the important point? So basically amortized cost treatment, yes, it is amortized cost only. Amortized cost, this continues to be amortized cost, but when there is a modification, how it will happen? We do accounting for modification like this, but continues to be amortized cost only. That classification is not changing, continues to be amortized cost. After transaction cost subtracted, EIR will be 11% and coupon will be 5% the table. Perfect, perfect. EIR will be 11% and coupon will be 5%. Correct. Okay. So we go to hedging. On extinguishment, only 58,092 P&L account. Correct. Only 5897 will go to P&L account. Loss on modification. Okay. If the change due to modification less than 10%, extinguishment won't apply. Yes, it won't apply. So you are not going to replace with the new loan. New cash flows will happen, and you compute the effective interest rate separately. But you are not going to compute any loss on modification. That won't apply. If it is less than 10%, extinguishment accounting don't apply. If it is less than 10%, extinguishment accounting don't apply. Shall we go to hedge accounting? Which case is relatively important from exam point of view? The problem what we solved now is important from exam point of view, because this problem is in your study material. Many of you may not know it, but in the exam this question is not come yet. This question is a very good potential question from exam point of view, what we just solved now. Okay, I think let's go for hedge accounting. Let's go for it before internet gives us some problem. Let's go for hedge accounting. This requires some of your basics of SFM, but I'll try my level best to connect that topic along with this discussion. Where extinguishment account does not apply, only year adjustment, yes, that is right. Okay, let us go into the concept of hedge accounting. Can you please confirm, is it fine? I don't want to come back again in between later. Okay, good. Now let's go to hedge accounting. Hedge accounting, again from exam point of view, I would not say it is very important because it has not come yet, or you can say it is important because it has not come yet. But in my personal opinion, they will not ask you very difficult question from hedge accounting because many people don't know still about this concept. But it is there in the syllabus, we'll do it. It is there in the syllabus, therefore we will do it. I will not do too much in depth, but I will give you an idea for sure. Let us move into hedging. Hedging means the process of covering risk. Hedging means the process of covering risk. So first of all, there has to be a risk, and hedging should be done to cover that risk. So whenever I talk about hedging, I always talk about two aspects. One, that is creating the risk, and the another, which is reducing the risk. So hedging or hedge accounting will always have two sides, will always have two parts, will always have two elements. That's what I keep telling. In simple words, in my SFM classes, I will be telling this, that hedging is having a backup before breakup. This is my common explanation. Again, don't take me personally, only for the purpose of giving you an example item. So many of you people who do CA also do BCom. Why? As a backup. In case something happens or something don't happen in CA, at least BCom is there. In your marriage invitation, at least you can write that BCom as your degree. So as a backup, as a support, you prepare that BCom also. That is called as hedging. That is the overall concept. You need to keep it in mind. Let's go further on this. So hedging means risk management technique, the process of minimization of loss. So there has to be two elements. One is hedging instrument and other is hedging item. And hedging item is what the risk is being created, and hedging instrument is what the risk is getting reduced. Okay. Along with the types, I'll explain the this also, examples also. So there are three major things. One is fair value hedge, cash flow hedge, net investment in foreign operation. So if I come to the concept of fair value hedge, what is fair value hedge? You are protecting the value, you are protecting the fair value. For example, you have a portfolio of shares where there is a risk of the price might fall down. If the price fall down, the portfolio value will reduce. You need a support for it. So what do? You enter into one short sale agreement on futures, index futures. So if portfolio will result in loss, this index future short results in profit. One loss, one profit. Your loss is minimized. Your portfolio is the hedging item which is protected, and the index future is hedging instrument. Since you're protecting the portfolio value, it is called as fair value hedge. Coming to cash flow hedge. In your foreign exchange chapter, being an exporter, I will receive foreign currency from my customer at a later point in time. But once I receive, I don't know at what rate I have to sell in the market. That rate at which I sell in the market, I don't know. There is a risk. To protect that risk, various hedging instruments are there. Simple one is I enter into forward contract. So exporter who received the currency from the customer would like to sell at a particular rate, he will enter into forward sale contract. So using the forward sale contract, what you're trying to do? You're trying to protect the money what you receive. You're trying to protect the cash what you receive. Therefore, it is called as cash flow hedge. The third one, net investment in foreign operation. You have investment in foreign subsidiary, joint venture in foreign country. That investment value you want to protect, because exchange rates keep fluctuating and other reasons also will happen. So only that investments in the subsidiary, investment in foreign operation, because it is a fair value component as well as a foreign exchange component. So multiple factors are there. So net investment in foreign operation is third part. So there are three types of hedge. Fair value hedge, it may be for protecting the value of asset or liability. Cash flow hedge, net investment in foreign operation. Now we'll go for hedge accounting. Now hedge accounting in simple words means Hedge accounting means, in simple words, matching concepts. The process of matching concept is the hedge accounting. Okay, now let me just simply go for the calculation of it. Conditions for hedge accounting: is hedge accounting compulsory? The answer is no. It has to be designated hedging item, existence of hedging instruments, formal documentation. You have to give it in writing that this hedging instrument is for the purpose of this hedging item. General condition, open-ended document cannot satisfy. There has to be a specific thing. This forward contract is for the purpose of protecting the money received from this customer. You have to specifically mention it. You have to give it in writing. Then only hedge accounting applies. What is the hedge instrument? To hedge the net investment in foreign operation. Anything. You can go for foreign currency swap. You can go for debt equity swap. You can go for a forward contract to sell also. So various things are there. So that will not go into it because it's more of a SFM concept. Let us come to accounting part. Accounting part, fair value hedge, very simple. Fair value hedge is hedging item as well as hedging instrument. The fair value change, both will go to P&L account. One star is there because suppose if it goes to OCI, it goes to OCI, investment in the nature of FET OCI. Where will you transfer it? You don't transfer it to P&L account, right? You transfer it to OCI. So hedging instrument also you transfer it to OCI. Basically matching concept. Just one second. Okay. Next. Coming to cash flow hedge. This is what slightly differential things are there. I'll explain. Could you please explain net investment in foreign operation part once? This is an element of fair value hedge as well as cash flow hedge. When you have investment in, let's say, shares of Apple company, no, not just investment in foreign subsidiary, foreign operations, in non-integral operations. An Indian company, let's say Tata's, has one Jaguar company in England, right? Like they have a, I don't know the ownership, I'm taking an example. So do you have a subsidiary in foreign company? Your investment is subject to that company's operations as well as foreign currency fluctuations. Investment in foreign subsidiary is an example of investment in foreign operations, net investment in foreign operations. That's the simplest as you can get. So fair value hedge is very simple. Difference will go to P&L account, hedging instruments also, hedging item also. But on hedging item, if it goes to OCI, like investment in shares in the nature of OCI, even the hedging instrument also will go to OCI as a matching concept. But fair value hedge and net investment operations have got similar treatment. This part I would like to explain with help of one simple example. Question is not there. I'll just explain with help of an example. Question I'm not doing it because no question have been asked in the exam yet. So let me just quickly take you for one simple example. Okay, before I go to example, any question you want to ask so far? Okay. I see no other questions coming. Let's go for one simple example. Okay. Let's go for simple example of debtors. Okay. That is goods sold on 1st Jan 2020 and the spot rate as on this date was let's say 60 rupees, and and the contract is for amount credit period of 4 months. So you enter into 4 months forward contract, forward sale contract, because after 4 months only you say receive the money, and the forward rate happens to be 64 rupees. Okay. Now year end, that is 31st of March 2020, let's say it happens to be, this is 61 rupees and this is, let's say, 64.5 rupees. Then on settlement on 30th of April 2020, the spot rate happens to be, let's say, 62 rupees, and this also will be how much? Can you tell what will be that number? Can you tell what is that question mark? Can you please, some people can confirm me? Okay, so that also will be 62 rupees. Okay, now what is happening? Please understand. Normal circumstances, what do? This is a monetary item, debtors, and this is a derivative. So in the year end, you will be revaluing it, reassessing it, and derivative also you will be computing fair value of it. Correct? Now, if you do this, the answer is not going to be correct. Let me tell you why. If this treatment will not be right overall basis when you do hedging, because now 60 becoming 61, this is a profit because you're receiving more. When the value of the asset increases, 60 asset becoming 61, it's a profit. 60 becoming 62, that 1 rupee profit is also there, 1 rupee profit. Now 64 becoming 64.5. Remember, forward rate, this is a sell rate, and sell rate means short transaction, and in short transaction when the rate increases it is going to be loss, so minus 0.5, and 64.5 to 2, this is going to be profit, which is plus 2. So what is going to be overall profit? 1 rupee, 2 rupee, 4 rupee minus 0.5, overall profit is going to be 4 rupees. Please confirm me if you get this overall profit calculation right. We are not doing hedge accounting here. Debtors value, I computed the profits separately. Forward contract rate, forward contract fair value, I have computed separately. And I have computed overall profit. I am yet to go for hedge accounting. Please tell me whether you people have understood till here. Any question on any of these profits calculation? 1 rupee minus 0.5 plus 2 rupees. Any point I need to explain here? This is 2.5. This is, sorry, not 2. This is 2.5. Explain once more. Can you tell me which part? Because explaining again from the beginning, this is not a regular class. We have to stay focused on what is required. So please tell me which area you want me to explain. That only I can explain. Repeating whole sum will consume lot of time. In the revision classes, we cannot afford to do that. Okay. Anything you want me to explain specifically here? Sir, could you explain why you take spot rate? In embedded, we compared 64 to 62. In embedded transaction, the contract was entered for sale of goods. Here goods are sold and then we collect the money. There are three things are there, my dear friend. One is agreement, where you enter into an agreement to sell later, then selling, then collecting. Three data points: one, agreement to sell, then actual selling, and then you go for collection. Here there is no agreement to sell. There is sell first, then you collect later. Only 2 points are there. So no embedded derivative here. Okay, 0.5 is a loss. 0.5 is a loss because it is a forward sale contract. If you consider a forward sale contract alone, you already committed for 64, which is your sell rate. But in the market 64.5. So if you consider this contract as a standalone product, how are you going to settle it? You will sell it at 64 as per contract, but buy in the market at 64.5. So buying at 64.5, selling at 64, it is going to be a loss. I'll repeat once more. You, okay, give me 1 second. Okay, I think you understood. That is good. Fine. Very good. I hope I can proceed further. Can you please confirm? Okay, good. Let's go further then. Now, overall profit, can you tell, okay, this overall profit is nothing but you booked at 60 rupees and you are going to realize 64. So you know this profit is anyway going to be 4 rupees from the beginning itself. In spite of all these transactions which are accounting for spot rate separately, forward rate separately, overall you know already for your profit is 4 rupees, because in your books you recorded at 60 rupees and you know your contract is 64. That means 4 rupees is your certain profit. That is your known profit, guaranteed profit. You don't have any doubt about it. So we should account for all these things. We should account for the debtors changes. We should account for the fair value changes in the forward contract. We should account for it, but our P&L account ultimately should reflect only 4 rupees. You understand, right? In a normal circumstances, if I consider debtor change, I will take it to P&L account. Forward contract, derivative, fair value change, I will take it to P&L account. But in this case, those profits are not right. Those profits are not right. I will take 4 rupees to P&L because I know 4 rupees my P&L account. Then you may ask one question. then why do you worry about fair value change? Take only 4 rupees overall, forget about fair value. That's what AS 11 says. But this Ind AS says no. Other standards also you should follow it, because foreign debtors will come under Ind AS 21. Forward contract derivative come under financial instruments. They have to be classified as fair value basis. So the debtors and the derivative should be valued on fair value basis in the balance sheet. But those fair value should not be taken to P&L account. Instead, they have to be taken to OCI. And what should be taken to P&L account is the 4 rupees profit. So these changes in debtors and changes in this forward contract, you will take it to OCI. Then what you will take it to P&L account is the 4 rupee profit. But the 4 rupee profit will not go to period in one time, because 4-month period, so it is amortized over 4 months. I hope you got the basics of cash flow hedge right. The changes in hedging instrument and the changes in hedging item is ideally should be transferred to P&L account as per other standards requirements. But that is not right, because there is a connection between these two, and we know this profit is going to be 4 rupees. So the changes in the fair value of the hedging instrument, hedging item should not go to P&L, should go to OCI. What should go to P&L? Which we know the profit, certain profit, hedging profit, which is 60 to 64, that 4 rupees will be transferred to P&L account over a period of contract period, in this case 4 months. So every month you transfer 1 rupee. The changes in the hedging item and changes in the hedging instrument will go to cash flow hedge reserve, OCI, and you will transfer 4 rupee profit to P&L account over a period of contract term. I hope you got the basics of hedging concept right. The same thing applies for net investment in operations also. Don't worry about that detail. If at all question comes in exam, this particular question comes, that is to extreme exceptional case. There is one good problem in the institute study material, which is on a loan bond in euro and GBP and dollars. GBP and dollars, that problem is there. They take a loan which is repayable after 3 years. That one big problem is there. I've discussed in my class in detail along with journal entries. You can search. Uploaded 8 hours financial instruments videos on the YouTube. That 8 hours has discussion on this hedging also. I've solved full-fledged problems also. So there you can refer for more details. So is it fine? Shall we go further to the next set of standards? Any questions you have? Please get it clarified. It's to profit on hedging item and hedging instrument, maybe, but that is not the purpose. Together we know profit is 4 rupees. So profit in P&L account will be 4 rupees. We are not going to account for hedging item profit separately in P&L, hedging instrument profit separately in P&L. No, that is not hedge accounting. If you account separately, where is hedge accounting? Hedge accounting means we are connecting the two, and net profit we are taking to P&L account. .5 net gain will record on 31st March and 3.5 net gain 30th April. We cannot amortize this, we know, only at period right. No, we know the profit is at the beginning itself. As on 1st of January itself, you know profit is 4 rupees, and 3 months happens in current financial year, 1 month happens in next financial year. Therefore, you have to do 4 rupees. Out of that, 3 rupee profit in current financial year, because there are 3 months, 1 rupee comes in next financial year. Please give journal entries. Please refer the full video. Otherwise, you'll be spending too much of time on this. You got the clarity, overall view of it. So for journal entries in simple problem as well as big problem, I've already uploaded free on YouTube. Please refer to that. After that, if you have any doubt, Telegram group is there. I am there. Ask your doubts. I will clarify it. We should consider time constraint also. Okay. How will know spot 31st of March? No, does not matter. No. I have entered into spot rate on 1st of Jan 60 rupees. I've already booked my receivable and I know I'm going to receive 64. My receivable is 60. I know I receive 64. 4 rupee profit, I know it. Other spot rates on the 31st of March and all is only for fair value accounting, which will go to OCI on the respective dates. But what goes to P&L is certain profit on account of hedging, which is 4 rupees, which is difference between spot rate on the date of sale and the forward rate on the same date. So difference will be transferred to P&L. 4 rupees profit known, that is hedging. You know the profit, you know that cash flow is certain, that is hedging. So whatever you learn in SFM, we are trying to give the effect in FR, that is hedge accounting. If you keep it separate, then you are not going to connect the two. That connection is important. That connection is 4 rupee profit. Okay, hope you got the point. As I told you, if you have any doubts, please refer this video once more. My full-fledged video, 8-hour video, I have uploaded freely on YouTube. Listen to that once more. Even after that, if you have any doubts, ask me. I'm there to support you. I think let's go further. We'll come to this point later. Let us concentrate on this portion. Ind AS 115. So today target is Ind AS 115. I'll take about 1 hour 10 minutes. Ind AS 116 about 1 hour 10 minutes. So between 2 o'clock to 2:15 we should wind up today. That is our target. Okay, Ind AS 115. So Ind AS 115, what do? We'll get the basic foundation right. Then we look at the every step overall what is point is considered. Then we'll take some problem to verify ourselves. Okay, now so Ind AS 115 is talking about 5 steps. The first step is being identify the contract with customer. Second step, identify the performance obligation in the contract. Third step, determination of transaction price. Fourth step, allocation of transaction price to performance obligation. Recognition of revenue when the entity satisfies performance obligation. So first is identify the contract. So there has to be a contract, need not be in writing, but there has to be a contract. If there is no contract, the Ind AS 115 don't apply. Now identify performance obligations. In every contract, every sale, there are 2 parties, seller, buyer. Now seller has got some rights and obligations, buyer has got some rights and obligations. Where will these things be mentioned? In the contract. That is why first step is contract. Now what the seller should do, service provider should do, is called as performance obligation. And what the buyer should give, what the buyer should pay, is called as the transaction price. Are you able to understand the 2 sides? Seller point of view, what he should do is performance obligation. From the buyer point of view, what he should do is transaction price. Now many performance obligation can be there, but one transaction price can be there. For example, when you purchase a car, they will tell you, you take the car and we will give you 2 free service. So only one amount is paid, one transaction price, but performance obligation is sale of a car as well as provision of services. So this is called as performance obligation. This one amount is called as transaction price. Now this transaction price should be allocated among these 2 performance obligations, because 2 elements are there, car and the service, but only one amount. That comes in step 4. Allocation of step 2 and step 3. Between step 2, step 3, how things are allocated, that is step 4. Now, performance obligation, transaction price, allocation also happened. Now, when should this amount be taken into books of accounts? In the step 4, we just computed. We did measurement. Step 4, we did measurement. But when it should be recognized in the books of accounts, that is step 5. What does it say? Whenever the performance obligation is satisfied. So when the car is transferred to the buyer, relevant for car, revenue is recognized. Then when the provision is actually provided, that is when performance obligation is satisfied, corresponding revenue is satisfied. All of these things, where do you get the information? Step number 1, contract. So step 1, contract. Step 2, performance obligation, what seller should do. Step 3, transaction price, what buyer should pay. Step 4, the allocation between 2 and 3, measurement principle. Step 5, that is recognition principle. Did you get the foundation of these 5 points right? After this, understanding this 5 point is a cakewalk. But the foundation principle has to be very, very strong. Can you please give me some yes for the foundations? And if you have any questions, please get it clarified. The foundation principles are very essential before we go further. Okay, very nice. Your foundation principle. Actually, if you know these 5 points, any problem you can solve with these 5 points only. Old syllabus, one of the question last attempt is mention the 5 steps. You just listen to me for 5 minutes, you could have got those marks. And even I'm telling you, new syllabus students, India's 115, some 120 page material. You get these 5 basics things right, any problem you can solve easily. The principles are important. That's it. Let's go further. Now let's come to the contracts. Okay, let me come to the contracts. What is contract? Agreement. What is contract term? Till enforceable rights and obligations are there. Those are parts what you learnt. Okay, this will focus. What are the criteria to be called as contract? Approved. If it is in negotiation, that is not a contract. It has to be approved by both the parties. Identified rights. Buyer and seller should know what are their rights and obligations. That is nothing but performance obligation. Identified payment terms, nothing but transaction price. Commercial substance should be there, and probable receipt should be there. Probable receipt is nothing but the prudence principle. Once you sell the goods, there has to be a probability you receive the money. If the chances of collections are less, don't recognize the revenue. That's a prudence principle. Now regarding commercial substance, this point is there in Ind AS 16 also, exchange of goods. This point is there in Ind AS 38 also, intangible asset. This point is there in Ind AS 40 also, exchange of assets. Commercial substance. Commercial substance are basically applicable for barter transactions. So if you exchange the assets without having the impact on cash flow, without having the impact on cash flow. This example we can use for Ind AS 16 also. I'll use it here also. Now, let's say a company replaces its car. Car is used by managing director for commuting between home and office. He's doing good job. So you thought, or if the car has become old car, you replaced it. In the process of replacing it, you have given the old car and you purchase new car, you paid the cash as difference. Now, because the MD has got new car, do you think the cash flow of the organizations will increase? sale of the organization will increase? The answer is no. But same thing if you compare it with a Ola or a Uber or any cab service company, if they replace the old car with new car, that has an impact on their operations, their cash flow will increase. So a situation where the exchange has impact on cash flow of the organization, there is commercial substance. Otherwise there is no commercial substance, and you should recognize the sale only when there is commercial substance. If there is no commercial substance, sale should not be recognized. More about it when it comes to Ind AS 16. Ind AS 38 we'll discuss it, where we take an example of problem odds. Contract in only sale, no, contract in which sale is mentioned, a sale which is taking place as per the contract. That's what contract from revenue with customers. Okay, next point, important point, contract modification. Okay, dear friends, can I ask you one thing? Can we extend today class to 3 o'clock? Can I get some answer? Can I extend today class from 2 o'clock to 3 o'clock? Okay. I just told you, don't worry, we will not be doing it. I just gave you an example of contract modification. What is the meaning of contract modification? I gave an example. Don't worry. I'm not going to extend. I'm trying my level best to finish by 2 o'clock itself. I gave an example for contract modification. The terms were, I will finish by 2:15. See, when I'm going for 3 o'clock, I asked your permission. You understand? That's how contract modification works. So what do you mean by contract modification? There might be change in the scope of the work, or there might be change in the consideration. Consideration is not changing, anyway free in our case, but scope of the work changed. So one of these two happens, there in such case it is called as contract modification. I'm not planning beyond 2 o'clock, 2:15. Don't worry, we will not go further. I'm trying my level best to finish by 2 o'clock itself. Okay, so two simple part. If the contract modification says that distinct product and a separate standalone price for that, then you treat as a separate contract. There is no distinct product, then you go for cumulative catch-up basis. Let me give an example. Let's say that you are attending my regular classes. My regular classes are, let's say I will, again I'm just taking an example, don't take that these are actual numbers, I'm taking an example. Let's say my regular classes are 10,000 rupees. And during the class, I gave you an option, I'm planning to conduct every day MCQ test. And MCQ test normally charges, I will charge 1,000 rupees, but for you people, I'll charge 900 rupees. Now, that charge I am doing for MCQ part alone, 900 rupees, does it represent a separate product? It's a separate product. Do you think 900 rupees is a price only for that? That is also right? Because 1,000 rupees I am giving you at 900 rupees. It's substantial amount only. So it is a distinct product as well as a distinct price. That means I'll keep it as a separate contract. I don't mix it with my regular classes fees. On the other hand, I'll tell you one more thing. Now, regular classes 10,000. MCQ normally I give it to others for 1,000. But if you come to my class, if you take my regular class, this I will give it to you at 200 rupees. Now that 200 rupees what I'm giving it to you, Do you think it is a distinct product? It is definitely a distinct product because it's a separate thing. MCQ part is a separate thing. But the price of 200 rupees, does it represent standalone price of any other person? Do you think they would have got 200 under any circumstances? No, it is connected with my existing part. So when I'm allocating my transaction price to recognize revenue, I should consider the whole product 1200 and have to divide between the two. I cannot simply go for 200 as a separate product. I hope you got the overall point. Contract modification, if the new product is distinct and the new product is having separate price, both points to be satisfied, new product and standalone selling price. If both are satisfied, keep it aside. If it is not satisfied, then you will account it on cumulative catch-up basis. That's what you have learned in AS7 also. That is, you compute what is the revenue already recognized minus the revenue to be recognized. Differential is the additional revenue to be recognized. That is what AS7 also you had earlier in day 11, and based on that a question also came in the last attempt in November 2019. A cumulative catch-up basis, basically retrospective accounting, no, retrospective calculation, not retrospective effect, but retrospective calculation. I'll come to that. We'll do one problem. I hope you got the point now on contract modification about distinct product and standalone selling price. Let's do a problem. And the contract is enforceable with or without penalty. I did not get your question. If it is enforceable with or without penalty, if your expectation is it is going to go through, we go for contract. We look on substance over form. If contract is likely to happen, then we account it. Otherwise, we don't. It depends on expectations. Okay, let's go from now. A website agreed to a design website for consumer service company. Initial contract is 200 hours at 20 each. Modification additional 50 hours, 25 each to complete the same project. Worked until date 30 hours. What should be the modification? Can you tell me here, is this a case of distinct product or not a distinct product? Is this a distinct product or not a distinct product? Okay, I'm getting the answers. Not distinct, correct? You are right, because it's to complete the same website, right? It is not a new website. It is not a new service. It is not a new product. Nothing new. It is just to complete same thing. Like the way you also do, right? What do you do? How you plan your exams? You're an expert in costing also, right? What do? You will have, let's say, 80 days. You have 40 chapters. What do? 80 by 40. Oh, one chapter has got 2 days. 40 days over. Then you will revise your plan. 40 days by 40 chapters. 1 day, 1 chapter. My plan is very good. 20 days over, no improvement. Still you do to a 40 by 2, it will be like 1 day, 2 chapters. Then 10 days over, no improvement. 40 by 10, the 40 by 10, 4 days, 4 chapters per day. You will know 4 days, 1 chapter, 4 chapter has to be in 1 day. I will divide the day into 4 parts. Breakfast 1 chapter, lunch 1 chapter, and then evening snack 1 chapter, dinner 1 chapter. Only these will become chapters. Chapter will not be covered. Then 5 days will go over. Still 40 chapter remain. Then also you're expert. You will divide the chapters into 8 days. So 8 chapters, one day 8 chapters you cover. That also, you know, you will be like before breakfast, after lunch, after getting up, before having brush. You are an expert in dividing it. Then 2 days over, still all 40 chapters left. Then what do? No problem. We'll revise it over a period of remaining 6 months. Anyway, next attempt, this attempt anyway you have given up. Anyway, don't think like that. Think positively. Try to do as much as possible. Okay, now what we are going to do it here. This is not a distinct product. Therefore, we have to follow cumulative catch-up basis. How cumulative catch-up basis works? If I knew this information from the beginning, what revenue should have been recognized, then compare it with the actual revenue recognized, differential, incremental, that is the revenue to be taken to P&L. That is what is called as cumulative catch-up basis. Okay, so no distinct products. Okay, so no distinct product. So what you should do? What is the revenue to be recognized? If you knew this from the beginning itself, if you knew this from the beginning, 200 hours into 20 plus additional 50 hours into 25 divided by total number of hours, which is 200 plus 50. Can you tell me how much this number comes to? This is per hour multiplied by multiplied by work done. Number of hours, 30 hours. Can you calculate this and tell me how much you get? I think you get 21 multiplied by 30. 630. And what is revenue already recognized? That is 30 hours into 20. 20 into 30 hours, 600. Therefore, additional revenue to be recognized, 30. This is what is cumulative catch-up basis. Hope you got this one. Okay, let's go further. Let's come to the second step, performance obligation. I told you performance obligation means what a seller should do, a promise in a contract to transfer to the customer a good or a bundle of goods that are distinct and a series of distinct goods and services that are substantially same, that have same pattern of transfer of the customer. A goods or service or bundle, you understand. One biscuit versus biscuit packet. A biscuit is called as good, a bundle of goods is called as biscuit packet. But second is interesting, a series of distinct goods. Okay, let me ask you one question. Newspaper today and tomorrow. Today newspaper, if I compare, can you tell me whether they are distinct products or same product? Today newspaper, tomorrow newspaper. Can you tell me whether they are distinct product or same product? Okay, the answer is distinct product. Today newspaper, tomorrow newspaper are not same, my dear friend. They are different, right? They are different. You are writing this exam, next exam is different. FR paper, SFM paper is different. It is different product, distinct product. That's the point I would like to make it. But it is a series of distinct product having same pattern of transfer. Today also newspaper comes, tomorrow also newspaper comes. The pattern of transfer is same, but the product is different. Product is not same. Hope you got it. Some is telling same product with different news. No, it is different product only. Okay, or cable connection. Today cable connection, today versus tomorrow, different. They are not same. In fact, every second is different product. Anyway, so the point is they are distinct product but having the same pattern of transfer. Pattern of transfer. That's what is performance obligation is all about. Okay, so promise in a contract. Activities are involved, features, unit of account at inception. Okay, that's not important. Okay, how do you say it is a distinct or not? Okay, this is point is important. How do you say performance obligation is distinct? Customer can benefit on its own with readily available sources. If he can make use of it on his own, it is distinct product. If not, it is not a distinct product. For example, newspaper. Today you get the newspaper, today only you got the benefit. You don't require, oh, I should read every day newspaper, otherwise today newspaper is waste. Nothing like that. So customer can make use of the product on its own without any dependence, therefore it is distinct. Compare with other things. You have given a contract for somebody to build the house. You have outsourced everything to him. That is, he will do the blueprint designing and he will do the construction and he will hand over the control to you. So in one day, the blueprint is ready, he will show it to you. Now using the blueprint, can you make the benefit out of it? Can you start using it for your purpose? No, unless the house is ready, you have not got your product. You can't make use of with readily available sources. Therefore, that is not a distinct product. On the other hand, have one more imagination example. You tell this like this, you please give me the blueprint. And once I get the blueprint, you give me the quotation for this. If I am okay with your quotation, then I will take it from you. If quotation is not okay, blueprint I'll pay you for it, I'll get the construction from somebody else. What does you think will happen here? Blueprint I will see, if I okay for the cost, then I'm go with him. Otherwise, blueprint I'll keep with myself, I'll go to somebody else. So blueprint part is one product, construction is another product. So we can't straight away say that this is distinct or not. In many cases, circumstances has to tell us. Okay. Promise to transfer separately, no significant integration service, no significant modification, not highly independent or interrelated. One example, basic, all the 3 points is, even if one of the points is not satisfied, then it will be becoming a not a distinct product. Anyway, so all the 3 points, essential element is, if you are having an agreement where multiple things comes up, should I think those multiple things separately, or should I consider all of them as separate or all of them as together? One example. You come to my FR class. I will give you one question bank which I solve in the class. So I'm providing you two services now. One, I'm giving you the question. Another, I'm solving in the class. One is material, other is teaching service. Do you think they are distinct? The answer is no, because unless I solve, you will not be able to use it on your own. There is an integration required. Unless those things do together, you cannot say that you can make use of it. One more example. ERP. You know ERP, right? Now, ERP, it is not only sufficient that it is you purchased it, they have to come and install it. Now, this license fee and installation fees, are they separate or are they together? Now, if it is for a standard software, then installation is a matter of routine matter. That is, it can be done by anybody. In such case, installation is separate and license fee is separate. But if ERP is customized, that means they should only come. Others cannot come and do it. We are dependent on them. The services of the installation and the license fee are integrated. Then that is not a distinct product, that is a same product. You take an example of mobile phones. You know, mobiles and SIM card can be separated. They can be used differently, distinct product. You know, earlier some CDMA mobile used to happen, where one mobile, Reliance Mobile, I think if you take, you can't take out the SIM card. Then they are integrated, they are dependent. In such case, they become distinct, not a distinct product, they become same product. Simple foundation. If they can be separated and used separately, it is not a distinct product. I mean, they are distinct product. If they have to be used in tandem, if they has to be used together, there is integration, then they are one product, not distinct. I hope this point is clear. Distinct performance obligation. Let's do a problem based on this. Question number 2. Please read. BBB Telecom Company provides broadband service to its customer along with voice call service. Customer buys the modem from the entity. Okay, so there is one broadband service, voice call service, modem from the entity. Customer can also get the connection from the entity and modem from any other vendor. Installation activity requires limited, installation activity is also there, and cost involved is almost insignificant. It has various plans where it provides either the broadband services or voice call or both, or the performance obligations under the contract distinct. So we have three things now: broadband, voice call service, modem. They said you can get the connection from another entity, modem from the other vendor. So modem can be used with other vendor, not only with this vendor. So customer can avail the benefit on its own or readily available resources. Therefore, modem is distinct, voice call is distinct, and broadband service also distinct. Okay, this is step 2 and one question we have done. Any question you want to ask on this, my dear friend? I don't think any buffering there. Shall you go to step 3? Okay. Step 3, transaction price. Transaction price means what the customer should pay to the company, entity, to the seller. So the amount of consideration which an entity expects to be entitled in exchange for transferring promised goods, excluding collected on behalf of third parties. Excluding collect on behalf of third parties means middleman point of view. If BBB Telecom won't provide separately, I don't understand the question. If BBB Telecom won't provide what? I did not get your question. Other operators provide separately. Okay, if BBB Telecom won't provide separately, then it is not a distinct. They are together because they sell, and not only modem they are selling, they have to sell the broadband service also. So they are together then. If they are together, they are not distinct. From the seller point of view, because he will sell the modem also, he will sell the service also. Okay, now transaction price. What entity which expects to be entitled, in their opinion, how much they will receive, and exclude collected on behalf of third parties, meaning intermediary will not consider. For example, you order food from restaurant through the mobile app Swiggy. Now Swiggy will collect the money from you and they will give it to the restaurant or the hotel. Suppose the amount what you are paying to them is 100, and Swiggy will have their commission charges of, let's say, 2 rupees, and they will pay 98 to them. So their revenue is only 2 rupees. Remaining 100 is collected on behalf of them. 98 rupees is collected on behalf of them and paid it to them. Therefore, what Swiggy should recognize revenue, not 100, only 2 rupees. It is relevant if other competitors sell separately, we should look from our entity point of view, right? But other entities, what they sell is also relevant, because if you sell the modem, can they make use of the modem with other entities? They should provide the service. The customer should be capable of using it on its own without you supporting it. Then it becomes separate. It becomes distinct. Okay, that is what is transaction price. Objective is measurement, recognize and performance obligation satisfied. Okay, you should not recognize the constrained variable consideration. I'll come to it. It may be fixed amount, variable amount like royalty, percentage of sales. It may be variable amounts. Customer business practice also have to be kept in mind. Okay, 4 important points are variable consideration, financing component, non-cash consideration, consideration payable to customer. Let us take one by one. Okay, then we come to this problem. Okay, before with these 4 points, first let us look at this problem. It's an MTP question as well as RTP question. This will give you an idea what the entity expects to receive. So once we are clear about that, then we go for the 4 angles in the transaction price. On 1st January 2008, entity J expects to enter into 1-year contract with a customer to deliver water treatment chemicals. 1-year contract. 1st Jan 2008. 1 year means 31st December 2008. The contract stipulates that the price per container will be adjusted retrospectively once the customer reaches certain sales volume defined as follows. Oh, interesting word. Adjustment retrospectively. What do you mean by retrospectively? If you purchase 1 to 1 million, your purchase price is 100 rupees. If you purchase more than 1 million, let's say 2 million, then your price will be 90 rupees. For what units? Not only for the units exceeding 1 million, but also first 1 million. Retrospective adjustment, the price for the current product as well as previous products, the price at which it is already sold will be retrospectively adjusted. Volume is determined based on the sales during the calendar year. There is no minimum purchase requirements. Entity J estimates that total sale volume for the year will be 2.8 million containers. Based on its experience with the similar contracts, forecasted sales to the customer. Entity J sells 7 lakh containers to the customer during the first quarter ended 31st of March 2008 for a contract price of 100. How should the entity J determine the transaction price? Please understand, 2.8 million is their estimation. So what is their estimation? Estimation will be 2.8 million, means this will be their expected final price, that is 90 rupees. And now they have sold 7 lakh and 7 lakh comes in the first category, and first category means they will receive 100 rupees. So they have received 100 rupees, but expectation is rupees 10 will be adjusted later in the next sales price, because they will go to second slab, and once they come to second slab, whatever you received extra earlier need to be adjusted subsequently. So against the units of 7 lakh you sold, you received 100, but in your expectation you are likely to receive, you are entitled to receive, in your expectation you are entitled to receive only 90 rupees. So 10 rupee is the additional amount you receive, which will be adjusted later to be treated like an advance. So 7 lakh into 90 rupees expected to receive, that will be revenue to be recognized, and remaining is shown as advanced liability. And when this advanced liability will be closed, when subsequent sales beyond 1 million happens, that point of time the liability will be transferred to revenue. As of now, it will be put it in advance, contractual liability. Okay, again you can take the quick screenshot, and I'll share the solution also later in the day in the group Telegram group. Okay, let's go further on the variable consideration. Okay, amount is fixed, contingent is fine, discounts, incentives, rebates are examples. Promise may be explicitly or implicitly stated. Recognize, okay, this is important. Recognize revenue is fine, but if significant reversal don't occur, then only recognize. If significant reversal will occur, then you should not recognize. If subsequent year sales is less than a million, then it is treated as revenue in that year. Changes in accounting treatment. If the estimate is not fulfilled, whatever advance what you thought becomes revenue in that year. Changes in estimates, recognize it. No retrospective calculation, it is not an error. It is a change in accounting estimate. In that year, liability will be transferred to revenue. Okay, now if significant reversal is likely to happen, then don't recognize. Let me give an example. Your parents would have told you, if you pass BCom exam or 12th or 10th standard beyond 90%, we will give you four-wheeler. If you get 80 to 90%, we'll give you two-wheeler, otherwise nothing. So can you go and enjoy today itself? You can, because you know you are going to get good marks in 10th or 12th. But can you do that in CA? Even CA, how the offer will be from your parents? They will tell you, if you pass CA, we will get you four-wheeler. Or if you get a rank, we'll get you four-wheeler. If you pass, we'll get you two-wheeler. If you fail, we will get you three-wheeler. Somehow you can manage. Anyway, the point is, when there is significant reversal, today you enjoy thinking that you will fulfill that. But if the chances of those fulfillment are less because of its nature or because of your experience in the past, the chances of fulfilling them is less, which means whatever you have recognized now, the chances of reversal are there. Prudence principle, don't recognize now itself. There are two methods. If you want to recognize, two methods are there. Expected value method, EVA, expected value amount, or EVM, and most likely amount, MLA. Expected value means your probability method. You know, you would have done the probability in SFM, possible share prices multiplied by the respective probabilities, price into probability, expected value you calculate like that. Expected incentives multiplied by probability, total, sum, average, expected value. That is expected value method. Most likely amount means only two possibilities, either you get or you don't get, binomial theorem kind of thing. So whether I get the bonus or I don't get the bonus. In such case, don't do probability approach, take whichever has the higher probability. So expected value means multiple things are there and you multiply by probability, you take an average. And most likely amount means only two possibilities should be there. Among the two possibilities, whichever has the higher probability, that amount you take it fully. No question of multiplying probability. Okay, constraining estimates, I told you what are the points which would have an impact. Now significant financing component. Financing component means interest. So in the transaction, if interest is included significantly, then you need to separate the transaction price and interest. Typical example, you know, installment sales, like you have to pay 1000 rupees for 6 installment, 6000 rupee will be transaction price. But you know, this includes interest also. So what do? You compute the cash price or the fair value. If it is sold on cash basis, let's say that comes to 5500 rupees. So 500 rupees you have to recognize interest income. They'll give you one practical expedient which is optional. If the time period of settlement is less than 1 year, then you need not, a choice given that you need not separate it. You can fully recognize it as sales. Because they think less than 1 year is not so material, you need not separate it. When the date of sale and the date of collection is within 1 year, you don't have to separate it. You can fully recognize it as sales. That is your significant financing component. Non-cash consideration. So apart from receiving cash from customer, you also receive other products like exchange of assets. I told you, in that case you go for fair value of assets. You receive cash and you receive fair value of the assets together. That will be your sales consideration. That is a state point. Now consideration payable to customer. This is one interesting point. Why will you pay consideration to customer? This typically happens in case of this supermarkets. Let's say there's one company called as Coca-Cola and there are customers, and Coca-Cola sell it to supermarkets and supermarkets will sell it to customer. Remember, supermarkets will buy and sell. They are not just intermediary, they are not just broker, they take the inventory risk on themselves. So for Coca-Cola, the customer is supermarkets, but it will be placed in certain shelf, right? So what Coca-Cola does, it will sell goods, but it also pays money for keeping the Coca-Cola in a certain shelf. Because when you go to supermarket, please observe the way the products would be arranged are phenomenal. Because if you see the way it is structured, you see that against billing counter only all these chocolates, all these small things will be there, so that you during the queue you can buy it, and all these biscuits, chocolates, junk food will be at the lower bottom so the children can pick up easily, and all the healthy items will be at the towards the end back side, so if you are a person you go and search it and find it yourself. So a lot of logistics is going to play over there. Anyway, keep it aside. So when you pay the amount to customer for a certain service, if the service is distinct, like shelf, distinct service, recognize it separately. But if there is any connection between the selling of this and paying of this, for example, you say, I will sell you, normally it is 100 rupees, I will sell it at 90 rupees now, and I will pay, normally it is supposed to be paid 10 rupees, I will pay 9 rupees. So when this kind of non-fair value calculation applies, then you should recognize this at fair value, this also at fair value. Basically, the sales needs to be adjusted. If there are some value adjustments between the sales and the amount what is payable by you to the company, then you need to go for the adjustment. The sales should not be recognized at what is shown here, it has to be shown at the fair value basis after adjusting any expenses. So that is the meaning of consideration payable to customer. Fair value of assets given or received. As per the standards, they just say whichever is clearly evident, but institute always takes the stand the fair value of asset given up. But in this example, I am selling the goods and I am getting the products. So from institute solution point of view, you take the asset given up, that fair value you take it. That is more safer. From exam point of view, standards say whichever is clearly evident. Okay, that is consideration payable to customer. Let us do a problem based on this. Any doubts so far? Okay, let's go for a problem. A Limited entered into contract with B Limited for constructing an equipment for a price of 50 crores. The entity has the opportunity to earn a performance bonus if early completion is as follows. 12.5% bonus of the contract price if completely by 12th month, 45% chance. 10% bonus if completely by 15th month, 30% chance. 2.5% bonus if completed by 18th, 15% chance. Additionally, there is a quality bonus of 1 crore if certain grading is achieved, which is expected to have 75% based on past experience. The customer consideration fully not clear. I'll quickly tell you. If you have to pay to customer for a distinct service, keep it separate, show it as expense. But your sales amount is influenced by the amount you pay. Your sales and the service what you receive, if these two are influenced, then show it on net basis to the extent of fair value. Don't keep it separate. Beyond this, if you want more understanding, Ind AS 115, about 3 hour 4 hour explanation I have uploaded on the YouTube free of cost. Listen to it. There I have explained with more examples. You get more clarity over there. Now here there are two types of bonus. One is early completion bonus, that is 12.5%, 10% or 2.5%. Three possibilities are there. Three possibility means we go for expected value method, probability multiplied by expected values. Additionally, there is a quality bonus, that is either you get or you don't get. So here we go for most likely amount wherever the probability is high. So let's go for the first one, early completion bonus, expected value method. Bonus percentages are given, that is 12.5% of the contract, 12.5% into 50 crores, that is 6.25, 10%, 2.5% of 50 crores, and last one is nothing. Probability given are 45%, 30%, 15%. Multiply 6.25 into 45, then 5 into 30%, then 1.25 into 15%, 0 into 10%, total 4.5 crores, that is the expected value. Quality bonus, most likely amount, the probability is high that you will complete it, 7 crores you can recognize. So these are the two methods. Don't spend time in writing, it's only to explain you the concept of Ind AS 115, the two methods of incentive calculation, variable consideration calculation. Okay, let's come to step 4, allocation of transaction price. Allocation of transaction price means, I told you, one transaction price are there but many performance obligations will be there. How do you allocate it? Very simple, you allocate it in the manner of distinct performance obligations. So in simple words, you can go for standalone selling price. For example, if 3 products are there, ABC, standalone selling price, if you sell that alone, standalone selling price, 10,000, 5,000, 3,000, it's supposed to be 18,000, but if you sell it 16,000, then in this proportionate basis you can do it. That is called as standalone selling price, proportionate basis. If standalone selling price not available, adjusted market assessment approach, meaning you take the same product is not available, so take a similar product and do some adjustments, that is adjusted market. Expected cost plus margin, that is your costing method. So you don't know the selling price, no problem, try to ascertain what would be the cost of the product at a reasonable profit margin, that will become a substitute for standalone selling price, or as a balancing figure you can compute. I'll show you a problem how to do it. It may be discount or any other variable kind of consideration also is allocated. Okay, let's do a problem to understand this. Please read the problem. Okay. Entity regularly sells products XYZ individually, thereby establishing the following standalone selling price. In addition, the regularly sells product XYZ together for 1 lakh. Case A, allocating the discount one or more performance obligation, entity enters into a contract with customer to sell the product XYZ in exchange of 2 lakh. The entity will satisfy the performance obligation for each of the product at different points in time, or Y and Z at same point in time. Determine the allocation of transaction price to Y and Z. Case B, the entity enters into a contract with customer to sell XYZ as described in the case. The contract also includes a promise to transfer product alpha. One more product is there. Total consideration is 2,60,000. The standalone selling price of product alpha is highly variable. Highly variable. We don't know the number because entity sells the product in a different range, amounts to 30 to 90,000. Determine the standalone selling price of products XYZ and alpha using residual approach. Case C, same facts apply except the transaction price 2,10,000 instead of 2,60,000. Okay, first, what are things you have? Case A, 1 lakh 50, 90, 2 lakh 40,000. And what you are selling for, the contract is you are selling for 2 lakh. You are selling for 2 lakh. And Y and Z together only you sell 1 lakh. So whenever you sell Y and Z together, anyway you will give 1 lakh. Which means the balancing figure 1 lakh is for product X. In other words, 40,000 discount is allocated to fully Y and Z, because when you sell Y and Z, 40,000 anyway you will give it. So first 40,000 give it to them, Y and Z, then it will come to X. But in this case, Y and Z discount only taken away, so entire allocation is for Y and Z, remaining will come to X, which is nothing is there. So X price will be 1 lakh and Y and Z price will be 1 lakh. That is the case A. That is case A. Case B. Entity enters into one more contract where product alpha is there and total consideration is 2 lakh 60,000. Okay, now total consideration is 2 lakh 60,000. So let me write it here, X, Y, Z. Not only X, Y, Z, you also have product alpha. Total 2 lakh 60,000. And what is X, Y, Z you normally sell? What we just calculated now. X, Y, Z what you are selling now for 2 lakh. And 2 lakh 60,000 is X, Y, Z and alpha. Therefore, balancing figure 60,000 is residual approach. And what is the range they are telling? Range is 30,000 to 90,000. So here we say residual approach is appropriate. Residual is in the range. So we say it is appropriate. That is case B. Now case C, if I come to it, everything is same. Take 2 lakh 10,000 instead of 2 lakh 60,000. So if I make 2 lakh 10,000, what will happen to this alpha balancing figure? That will come to 10,000. Now 10,000, is it in the range? Range is 30 to 90,000. It is not in the range. So 10,000 is not in the range. So residual is not appropriate. Then what is appropriate in this case? That they should go for it. Adjusted market assessment approach or cost plus profit approach. Some approach we don't know in this problem, but we just have to say residual approach in case C is not appropriate because the residual amount is not within the range. So that's how you analyze case A, case B and case C. Okay. Any question on this? Question number 4. Then we go for question number 5. Solution, I'll share it in the material separately, in the group separately later. Oh, this is question number 5, I think. Yeah. Okay. Is it done? Shall we go to the next one? This is an MTP question. Okay. An entity enters into a contract for the sale of product A for rupees 1,000. As part of the contract, the entity gives the customer 40% discount voucher for any future purchases up to 1000 in the next 30 days. The entity intends to offer 10% discount on all the sales during the next 30 days as a part of seasonal promotion. The 10% discount cannot be used in addition to 40% discount voucher. The entity believes that 80% likelihood that customer will redeem the voucher, and on an average, a customer will purchase 500 on additional product. Determine how many performance obligation does the entity have, and there are standalone selling price and allocated transaction price. Please read the question once more. Okay, now please observe this 10% discount will be anyway provided on all sales. That is anyway is going to happen, and this customer or you are providing as a part of the contract 30%. So how much additional discount that this person will get? Additional discount is only 40% minus 10%, that is 30%, and that is the discount which you need to allocate it for the purpose of this voucher. So 30% is what you need to understand, it is relevant for voucher. Now 10% anyway will happen for all products, that is not relevant for this contract alone. For this contract you have 40%. For other contracts anyway you will have 10%. So what is the thing which is allocable for this contract? 30%. An entity believe only 80% of the likelihood, means only 80% will be used, that they will redeem the voucher on an average, and customer will purchase rupees 100 on additional products. So what is the discount amount? What is the value of the thing which you can calculate it for this discount voucher? Value of voucher is rupees 500 is what is going to be used. Average price multiplied by 30% voucher value, and not everybody will use, only 80% of the people are likely to use. So how much it comes to? I think it will come to rupees 120. They've asked what are the performance obligations. So performance obligations are: 1, to sell the goods today; and second, sell goods later against voucher. Then they've asked the allocation of transaction price. So how do you allocate? The amount received is rupees 1000, and the amount of which is what is goods sold today is 1000 rupee again, and the value of the voucher is 120. So proportionately ratio calculated wise, this is 1120 and this is 1000. Cross multiply, thousands into thousands by 1120. I think that comes to 890, and this balancing figure you can say this comes to 110. So total is thousands. Okay, so that's how the allocation is being done in case of the discount voucher based on its expectation to utilize. And amount received is 1000. That 1000 rupee is towards is 890 110 correct? Some of you are telling 892 or something. 1000 into 1000, 1000 into 1120. No, 1000 into 1000 by 1120, correct. 1000 into 1000 by 1120. Hope you are getting 890. $892 you are getting. Okay. Okay, 892 you are getting. So I'll write it 892 and 108. 108. 893, sorry, 893, yeah, 893, 107. Institute solution, they have rounded it off, so they have done the calculation. That's fine. That rounding it is fine. That is left to you. They have taken 4 decimals and rounded it off. But actual answer is 893 and 107. Okay, let's go to question number 7. An entity sells or entity enters into 1000 contract with customers, each contract included in the sale of one product 50 into 1000, 50,000. Total consideration. Cash is received when control of the product transfers. Entity customarily business practices is to allow customer to return any unused product within 30 days and receive full refund. The entity's cost of each product is rupees 30. Since the contract allows customer to return the products, the consideration received from the customer is variable. To estimate the variable consideration the entity will be entitled, entity decides to use the expected value. Using the expected value method, entity estimates 970 product will not be returned. Entity estimates that the cost of recovering the products will be immaterial and expects the return of the product can be sold at a profit. Determine the amount of revenue, refund liability, asset to be recognized by the entity for the said contracts. So 1000 contracts was entered and they know that 970 products will not be returned. So out of thousands, 970 will not be returned. So you can recognize sales. But on 30 products, this likely to return, that means no sales. No sales means what about the money already received? You have to treat it as advance, or they will call it as contractual liability. Because no sales, but money already received, so it is an advance. You have to refund it, refund liability. And also 30 products is not with them, it is with the customer. It will come back to you. It is your product only. Maybe with the customer it is your product, so you have to recognize the stock lying with customer because it's not sales, it is your product. It has to be in the inventory, closing stock. So what the institute has given solution, let me show the institute solution only. So they have told, let me just expand it. The institute solution theory, you can read through it. So on the 970 products, 50 rupees revenue recognized, 48,500 rupees. On remaining 50 units refund, therefore they have recognized a liability, and remaining 30 units is your closing stock, therefore they are showing it a asset, that is as a closing stock, as a inventory, they are recognizing it. So 3 points you have to mention: revenue, how much, to the extent of units sold; advance a refund liability to the extent of asset likely to be returned; and show it as inventory for those units because they are likely to be returned, means it is not sales, it is unsold goods, part of your closing stock. Okay, very nice. You're getting concept clarity, very good. 48,500, 1,500, 900, perfect. That's it. In fact, you don't require Ind AS 115. You know the concepts, basics of sales. Previous problem, will you share the solution? I'll share the solution. Institute solution only. I'll share it. Don't worry. I'll share it. I'll share the solution in the group later. If you have any doubts there, you can still ask. I'm there to help you there also. No problem. Okay. Let's go to the last step now. When the revenue should be recognized, they say whenever the control is transferred, and indicators are there: right to payment, legal title, physical possession, customer acceptance, significant risk and rewards. But the important word is control. All these are indicators. But once the control is transferred, then the revenue can be recognized. There are two methods. One is performance obligation over time, and another is performance obligation in the time or at time. If not returned within stipulated time of contract, it should be recognized as revenue. Yes, it will be. And whenever the contract period is over, then the advance liability will be transferred to sales, and the closing stock, what is shown, that will become cost of goods sold. Thereby, profit is recognized. Fine, that is correct. To understand this concept of performance obligation over time or at a time, you need to listen to this one common term we use. We say, no, people say we should enjoy, as if after all we live only once. I have slightly difference of opinion on this. You die only once. You live throughout. Every day you live. One day you die. So life is performance obligation over time, and death is performance obligation at a point in time. I hope you got the basics. What do you mean by over a period of time and at a point in time? CA, to be eligible to sign an agreement, to sign the balance sheet, it is not over a point in time, it is at a point in time. You have to become CA, COP, then you get the eligibility. You can't say that I have entered clear 50% of See, I have done. So 50% of the audit I'll do, 50% of the balance sheet, only liability side I will sign. Can't happen. No proportionate recognition. Unless you complete, you have not completed. You might have knowledge, but you don't have the power. Anyway, so let's come to the topic. So performance obligation over time, even if one of these conditions are satisfied, performance obligation over time, that is over a period of time, proportionately you can recognize. Simultaneously receives and consumes the benefit. So as and when seller provides, the buyer gets the benefit. For example, we are doing a class now. As and when I'm explaining, you are getting the benefit. So simultaneous consumption. That is what this part. Creates an asset the customer can control. Create an asset the customer can control means the seller provides the goods. For example, the contract is to install 10 lifts in a building. 10 lifts. Now the condition is, unless all 10 lifts are completed, it cannot be used. That means one lift is completed, customer cannot start using it. Second lift is completed, customer cannot use it. So not performance obligation over time. On the other hand, think about another situation. You have the agreement such a way, as and when one lift is installed, customer can use it. Next lift, customer can use it. That is, the customer is getting the control of the product. Therefore, it entitles performance obligation over time. So as and when one lift is installed, the customer can start recognizing revenue. The last one is enforceable right to payment, reasonable profits. That is, unless, if the product is in between, for example, you are doing a, let's say, what do you call in merger, peer review, now when something is there, what do you call that audit? I forgot the name. Some audit you call it, no? What do you call it? Due diligence. Yeah, due diligence. You do due diligence before merger. Okay, you give a report. Now, as and when you start doing the work, do you think customer get the benefit? No. Do you transfer anything to them? No. Now, if the work is not completed, in between, do you have the right to receive the income? We don't know. That depends on the terms of the contract. If terms of the contract says, in the event of early closure, you are entitled to receive money for the work done till date, then it is satisfied, this third point. If the term is not there, that in between, if things get closed, you have not transferred any benefit, you don't have any right to receive the money, revenue cannot be recognized. So far we talk about substance over form, but this last one is more on a form than substance. In the form, do you have the right to receive money for the work done? If one of these points is satisfied, performance obligation over time, proportionately you recognize, otherwise you recognize it on at a point. So the moment it is transferred, revenue is recognized. Till then, you will show it as inventory. Performance obligation over time, performance obligation at a point in time. Yeah, due diligence, correct. That's what I was telling. Okay. Okay, so there's only one point I would like to discuss. After that, I will go to Ind AS 116. Any doubts so far? Okay, there's only one point I would like to discuss, that is sale and repurchase. So you sell goods today, let's say at rupees thousands, and you have an agreement to repurchase it at rupees 1200 later. So you are selling 1000, you get the money, then you purchase the goods, you repay the money. So this is not actually a sale transaction, this is a financial rearrangement transaction. Therefore, you should not recognize its sales, you should recognize 200 rupee as financial expense, interest expense, because you're borrowing 1000, you're repaying 1200. That is the treatment you have to give, and over a period of the contract, recognize it as 200 financial expense. If it is not 1200, if it is, let's say, 900, you are selling at a higher price, repurchasing at a lower price. Repurchasing at a lower price means, why will you repurchase at a lower price? Because in this period, the person to whom you have sold is using the asset. So you are charging him for that, using the asset. So you treat it like a lease payment. The difference, if it is more, if the sale price is more, you treat like a lease payment. If the sale price is less, you treat like a financial expense. That is one thing, sale and repurchase agreement. Sir, POT is like a percentage of completion. Yes, for understanding purposes, definitely you can say. There are many methods. Percentage of completion is also one of the methods, like input method, output method, measurement method. Many methods are there. Percentage of completion is also one of the method. Completely correct. Yes. Okay. Let's come to the most important point, the latest standard, newly born baby, yet to be asked in exam. I'm sure they will ask in exam. Ind AS 116, lease. Both Ind AS 115 and 116 are very important from exam point of view, because they are new standards. Many people, even in industry, including CAs, are learning. So examination has got a higher chance. And as far as many of the students' feedback is concerned, I have observed somehow you are not comfortable with Ind AS 115, 116 financial instrument consolidation. Wherever you are not comfortable, institute is very, very comfortable in asking those questions, because their objective is to test you. And if they know you are not going to be comfortable, their job is easy. So you have to think on those points, and you should focus on those points. Then you will be able to get more marks than others. In our regular crash course also, I have done this value pack where I have included consolidation, financial instruments, Ind AS 115, 116, only value pack. For Google Drive, I had not provided. Let's see, we are thinking with our office people, if possible, I will try to come up with only that product where consolidation, Ind AS 115, 116 and financial instruments, only these four will be possible. So that will be about 4 days sessions. You can pay only for that and get it. We'll let you know the group, our Telegram channel, we will announce it, because quite a few people have asked for it. Anyway, let's go further on Ind AS 116. Let me tell you what is the major change, fundamental change as compared to previous Ind AS, fundamental change. You know, there are two parties as per Ind AS. I mean, the one in lease, one is called as lessee, other is called as lessor. Person who takes the asset is lessee, the person who gives the asset is lessor. Now in the lessee, there are two classification of lease. One is operating lease, other is financial lease. In the lessor, operating lease and financial lease. Now Ind AS 116, what is happening? This classification for lessee, operating lease and financial lease is taken out. And for lessor, operating lease, financial lease continues. That is the fundamental change. So lessee, the classification of OLFL no longer exists. So they have only two choices, either the standard apply or the standard don't apply. And if the standard don't apply, we say exempted leases. Some exemptions are given, so you need not apply in those cases. But the moment you apply in Ind AS 116, the standard is fixed. You have to go for particular method. Again, in Ind AS 116, my entire regular class, 8 sessions of 3 hours each. That portion I have uploaded on the YouTube. Please watch it if you have time, if you want to understand in detail. 8 hours, 8 session, 3 hours each, 24-25 hours I have covered. Anyway, this is only a revision part now. So lesser, operating lease, financial lease continues, but for lessee, no such classification. Exemption is provided, otherwise you have to apply the standard. Okay, so option exemption. Okay, there are 2 optional exemptions provided. One is short-term lease, other is low-value items. Short-term lease means less than 12 months. If the lease contract is less than 12 months, then you can show it as an expense straight away. To the extent of you make the payment, this standard don't apply. Low value items are small value items. The standard don't define what is low value. You have to apply materiality concept. So if it is low value items, like you enter into chairs, small chairs, small computers, or those kind of things, small chairs or small utensils, lease agreements, you need not apply this standard. Otherwise, if the optional exemption, you can recognize it on expense basis. You don't have to worry about applying this standard. Now let's come to this standard, lease. In Ind AS 116, what does it tell? You will provide lease means it conveys use of asset, but ownership is not transferred. So you only get the right to use, but not the right to own. Inception means earlier of lease agreement date or date on which you actually commit yourself into. Okay, at inception date you're going to start recognizing all these things, but accounting part will happen only from the commencement date. Inception date means the lease agreement taken place or commitment takes place, whichever is earlier. But once the usage starts, the commencement, then only you pass journal entries. Till then, entries are not passed. Okay. Definition: a contract conveys right to control use of an asset for a period of time in exchange of consideration. Okay. Important points are there. This chart, again, I will give you a very brief idea about it. We cannot go too much in detail. The asset has to be an identified asset. Like, for example, a company has entered into an agreement with a cab service company to provide cab service for employees if they stay beyond 9 o'clock. So beyond 9 o'clock, you can call this cab service people, they will take you home. Now this agreement, is it lease agreement? The answer is no, because the car is not identified in the agreement. They have to provide some car. The asset is not identified. So it's not a identified asset. So it becomes a service agreement, not a lease agreement. Then this substantive substitution right. Substantive means we say substance over form. In substance, who is the owner? So points are there, but what point to be kept in mind is who is the ultimate controller, not of the asset, but who decides the control of the use of the asset. One example is there from study material example only. There is one solar plant. Okay. Now A Limited gives the solar plant to B Limited. So B Limited is basically, if you apply this time, he becomes a lessee. So A is the owner and B Limited is the who uses the asset. Now government gives 2 kinds of subsidy. For the owner, 20% of the cost will be given as subsidy, and to B, whatever the output produced, 20% of the output will be given as subsidy. So both A is getting one benefit, B is one getting benefit. Now here, can you tell me who is using the asset according to the use, meaning who is directing the use? That is important point. Who is directing the use? Who is directing the use? Can you tell me the answer? A or B? A is getting one benefit, B is also getting one benefit. A is getting 20% of the cost of the asset, B is getting 20% of the output produced. Who is getting the benefit of the asset now here? A is getting the benefit of the asset, B is getting benefit of the asset, or both? B, both. B, okay. Okay. Both are getting the benefits. But what you have to understand is standard users ROU, right of use. Who is getting the benefit of using the asset? Using the asset, not owning the asset. Use, right of use, how the solar plant to be used, how many units to be produced, how many units to be sold, when to be produced. Use is with B, and therefore for the use he is getting the 20% of benefit. A cannot determine how much B should produce, therefore answer is B. Right of asset lies with B. The standard Ind AS 116 applies. And in AS 116 applies. But if A would have to direct the control, direct the use, that is, A will tell you should produce this many units, A will tell this days you should not produce, A will tell you cannot use more than this. So when A direct the use, in such case A will get the asset right of use, not B. Indian 116 don't apply. Hope you got the difference between the supplier versus customer relationship. Important here. Single point of principle. Who controls use? ROU, right of use. That's it. This point. Let's go further. Right of control. Overall, I explained. Right to direct the use, identified asset. Separate lease and non-lease component. This point I have to explain. If the practical expedient is used, no need to separate. Practical expedient means that a short-term lease, low-value items, you need not do it. Otherwise, you need to do it on standalone selling price basis, SASP. What do you mean by separating lease and non-lease component? For example, you take an example of rent. You pay rent for the building. You also pay for maintenance charges. Together you pay 10,000 rupees. Now rent is towards lease, but maintenance charges is towards maintenance. So maintenance is not part of lease agreement. That is non-lease component. But how much is there? We don't know. Divide. How do you divide? That is, if rent charges standalone is let's say 12,000, some number 12,000. Maintenance charges is 1,000. In the ratio of 12:1, you divide. Okay, that is separating lease and non-lease component. One of the popular expense is municipal tax or property tax paid by lessee to lessor. Can you people tell me, property tax paid, is it lease component or non-lease component? Can you tell me, is it lease component or non-lease component? Property tax. Property tax, is it lease component or non-lease component? Lease component. Lease. Good, all of you are right. Lease component, because the lessee is not receiving any distinct service by paying property tax. Why you pay property tax? Because you are having the property. You are not receiving any distinct service. Security service, if you pay, you get security service, non-lease component, distinct service. Electricity charges, you're receiving the benefit of electricity, not the building, that is non-lease component. Hope you got the basic logic between what is lease component and non-lease component. Should be divided based on proportionate basis, standalone selling price basis. Combine the contract, portfolio application. Okay, this part you don't worry. Lease term is non-cancelable period, where if two parties cannot cancel, enforceable on both the parties, then that period is called as enforceable period, lease period. If the option to extension is there or option to terminate is there, both are considered. You can take an extended period, you can take a shorter period based on reasonable expectation. Based on reasonable expectation. And reassessment can happen, like originally you thought 5 years, then later you might revisit to 6 years, can happen when significant event occurs, non-cancellation period is changed as per mutual agreement, or any factors within the control have affected, some reasons, any reasons can be considered. That is for lease term part. Lease payments, okay, this is important. Lease payments are fixed payments less an incentive like cashback. Variable payments are also part of lease payments, depends on index or rate. Index means your LIBOR rate, maybe interest rate or inflation index, CPI index, or inflation index, you have CII, cost inflation index as per income tax. When the payments are connected with those index, then it is part of variable payments. Suppose it's connected with percentage of sales, percentage of number of units produced, that is not part of lease payment, that is royalty, separate. Excise price, penalties, residual value, okay, residual value for lessee guaranteed by him, but for lessor guaranteed by him, lessee or even third party. So total residual value you take it for lessor, only guaranteed residual value you take it for lessee. Non-lease components are not part of lease payment. Variable payments are not part of lease payments. Lease incentive means like cashback, you subtract. Variable lease payment, I just explained. Lease accounting, this is an important point. Let us discuss this. This is important. On the commencement date, lessee, this is lessee, remember, he recognized ROU asset and lease liability. So journal entry is ROU assets to lease liability. And how do you compare lease liability? You're telling here lease liability is present value of lease payments. So you recognized asset as well as liability. What is lease liability? The present value of lease payments. What I'm likely to pay, that present value will be called as lease liability. How do you get ROU asset? Whatever the lease liability portion, this will come, plus any direct cost incurred, payment made before commencement, that is not part of lease liability, that will come. Estimated cost of restoration, cost of dismantling as per Ind AS 16, Ind AS 37, cost of destruction, dismantling also is added, and any less incentive received before the commencement, that is also being subtracted. If it is part of lease payment, anyway subtracted, but lease incentive which is not part of lease liability, meaning lease incentive received before commencement, then that is also being subtracted. So this is a basic journal entry. This portion is important, and going forward what will happen? On lease liability, you are going to charge interest expense, whatever the rate you have used, and ROU asset means you charge depreciation. And depreciation as per Ind AS 16, that is depends on what class of assets this belongs to, machinery, building, whatever may be. So whatever the method of depreciation you apply for other class of assets, this also you can provide. Simplest is SLM, you can provide other methods also, but in line with the depreciation method for the class of assets, what you provide, otherwise. Okay, so I think maybe we should take one problem on this. Substitute measurement, as told you, on ROU asset, you provide for depreciation, also impairment if any. Remeasurement, I'll come to it. Lease liability, interest on amortized cost basis. Expense, depreciation goes on the ROU asset. Impairment on the ROU asset. Interest expense on the liability. And variable lease payments, because it is not part of lease payment, that will directly go to P&L account. Okay, so before we go to problem, any question you want to ask? This lease liability is amortized cost as per Ind AS 109. Yes, it is as per Ind AS 109 logically or conceptually, but not legally. Meaning they provide the same principle in this standard only. So whatever you understand, the process of amortization applicable in Ind AS 109 applies this also. Conceptually applies, you can say that, amortized cost. Any questions before we go to one problem? I think this is a RTP problem only, or MTP problem, I think. Yeah, MTP, May 2020 question. No, small one. Okay, sorry. Yeah, MTP question. MTP question. What about GRV? Usually I told you, lesser when he takes as a lease payments, lesser will take total residual value. Lessee when he takes only what he has guaranteed residual value. So lesser point of view, total residual value, guaranteed as well as unguaranteed. Lessee point of view, lease payment means only what is guaranteed by him, GRV for lessee. So can you please share? I think I've already shared, maybe. Please check it out. I would have shared in the Telegram channel already. In the media files you share, check it. I'll also check it. If it is not shared, I'll share entire charts of Ind AS 116. No problem. Can we go to problem? Any questions? Okay. Let's go to problems. So lease liability between lessor and lessee differs because of UGRV. Lease liability, the concept applies only for lessee. Lesser amount calculation is done differently, concepts are different, classification is different. He will do financial lease, operating lease and all. So don't compare between the position of lessee, lessor. The amounts will not be equal. That is why we don't call it as financial asset. The amounts will not be equal. Anyway, don't go to such stage. Don't compare the amounts between lessor and lessee. Amounts will not be equal. May be equal because their discounting rate is different. This person discounting rate is different. So amounts cannot match. So don't compare that. Can we go to the problem, my dear friends? Two PM. I'll try my level best, my dear friend. 5-10 minutes I might extend, but I have to finish Ind AS 116. I don't want to drag it further. Other concepts are also important. 116 will get over fast, don't worry. We'll try to do it. And as usual, don't write the solution. I'll show you the solution fast and I'll share the solution in the group. Okay, let me go further. Okay. Company EFG enters into lease property with entity H. Initial term of the lease is 10 years with 5-year renewable option. The economic life is 40 years and the fair value of the lease property is 50 lakhs. Company EFG has an option to purchase the property at the end of the lease term for 30 lakhs. Lease is paid at the beginning of the year. Oh, this is a bomb. Lease is paid at the beginning of the year. The first annual payment is 5 lakhs with increase of 3% every year thereafter. The implicit rate of interest is 9.04%. Entity H gives company EFG an incentive of 2 lakhs payable at the beginning of year 2, which is to be used for normal tenant improvement. Company EFG is reasonably certain to exercise the option. So reasonably exercise meaning you take that renewable also. How would EFG measures ROU and lease liability over lease term? Okay, let us calculate lease liability. Let me use year, cash flow, discounting factor at 9.04%, discounted cash flow. Amount is paid at the beginning itself, year 1 commencement itself they have paid. So I would like to show like year 1 or I'll say year 0 because beginning itself it is paid. Cash flow is payable. Annual payment 5 lakh. Oh, increase of 3% every year. Oh, so you can't take annuity factor and all. You have to calculate every year separately. Okay, so cash flow is 5 lakh. Discounting factor you have to do. Okay, let me do one thing. I'll calculate in the Excel quickly. You don't write it down. And I'll come to it. I'll come to it. I'm just this is taking some time, so I'll just do it in Excel and pull it to you. Just give me 2 minutes. I'll put it quickly. Solution I've not put it. I'll come to it quickly. Just give me 1 minute, I'll put the solution. Okay, I'll put the solution. Now you can check it out. Since payments is that the beginning of the period started as year 0, then 1, 2, 3, 4, 5, 6, 7, 8, 9, basically 10th year beginning, then 10th year end, at the end of the lease term, this will come. So I've taken this number, so present value come, I've taken 4 decimal, institute has taken 2 decimal actually, so it will come to 50 lakh. So journal entry will be ROU assets to present value of lease liability, approximately let's say 50 lakhs. This will be the simple journal entry as far as this problem is concerned. You can look at the solution. Tell me if you have any doubts. Second year, I've increased by 3%, but incentive was there. So this is 5 lakh into 1.03 minus 2 lakh incentive is there. I'll subtract. I'll share solution. Don't worry later. Just try to understand. That's sufficient. I've taken 30 lakh also at the end of this period. Since the question said the entity is reasonably certain to exercise the purchase option, we have taken 10-year period only. If the entity did not have it, then you could have gone for 15 years. But here they said entity is reasonably expected, so I've taken 10-year period. Okay. Any question? Shall we go further? Okay, only one question. On ROU asset, entity is going to charge depreciation. Can you tell me how many years over which it's provide depreciation? 10 years, 10 plus 5, 15 years, or 40 years? Can you tell me under this depreciation is charged over how many years in this case? ROU asset 50 lakhs. Depreciation is charged over how many years? 10 years, 40 years, or 25 or 15 years? Manjay Tiwari is asking what is difference between modification remeasurement. We'll come to it. We have that point yet to be discussed. We'll do that. Okay, 10, 15, 40. The answer is 40 years. Because entity is likely to exercise the purchase option. Means entity is likely to be the owner for 40 years. Its useful life. If the entity was not likely to purchase, then 10 year is correct. Hope you got the point is clear. Gautam Ramesh, second year is 5 lakh into 1.03, 1.03. No. At the beginning of second year. At the beginning of first year, you pay 5 lakh. At the beginning of second year, you pay 5 lakh 15,000 minus 2 lakh. The second year beginning, second payment. First payment is 5 lakh. Second payment is 5 lakh into 1.03. That's all. 3%. That's all. Payment at the beginning of second year. Let's go further. Okay. So somebody is asking remeasurement and lease modification. I'm coming to now. First we'll talk about remeasurement, then we'll talk about modification. Now remeasurement. When the remeasurement takes place, when the lease term is reassessed. Earlier you thought you purchase in this example. Now you're thinking, no, I will not purchase. Reassessment of lease term. Reassessment of option to purchase. Earlier you thought you will not purchase. Now you think you will repurchase. In substance, fixed lease payment. Lease payments, you can say that. GRV changes. Residual value will change. Estimations is changing. Future lease payment because of index is being changed. So for these reasons, it is called as remeasurement. Remember, you are not going for additional rent, additional lease. You are not taking any new machinery. You are not taking new rental, new building, nor you are not reducing the scope. The scope remaining same here. Okay, when the scope changes, that becomes modification. Remeasurement of liability means one of the estimates, accounting estimates, what you thought earlier will change. That is not lease modification. Lease modification means scope should change or the fundamental lease payment should change. Whereas remeasurement means whatever assumptions you had made earlier to compute ROU asset and lease liability, one of the assumption got changed, change in accounting estimate. Now remeasurement, once you do, you will not take it to P&L account. You will adjust in ROU asset, lease liability. If increased, ROU asset is increased, lease liability increased. Decreased, ROU asset decreased, lease liability decreased. Nothing to P&L account. If ROU asset is 0, if it is fully depreciated because of impairment, then you can take it to P&L account. The change is because of remeasurement. Now, which rate of interest should be used? Lease term change or purchase option change, you take a revised thing. In all other cases, you going for original discount rate only. So don't try to remember both. Remembering both will confuse you. Remember only one. Revised rate for lease term and purchase option. Lease term, purchase option, revised term. Remaining are all original discounting rate. If lease payment changes, lease payment change is not here. See, payment on index change is different. That is index change, not lease payment change. If lease payment itself is changed, lease rental you thought 10,000, then negotiation came and you thought 12,000. Lease payment change, that will be lease modification. Lease modification because scope is changing or price is changing. Okay, their revised rate will come. So revised rate for lease term, revised rate for purchase option, revised rate for modification. Everything else original discounting rate. Are you clear on this point? Don't try to remember both. Remembering too many things, you will get confused for sure. Are you clear about the rates? When to use revised rate and when to use original rates? Please explain once again. Okay, I'll do it once more, but I cannot do it too many times. You have to be specific in your doubts. Lease modification means there is a change in scope and or there is a change in lease term because of lease payment, because of negotiation. For these two reasons, change in price, change in scope. You remember Ind AS 115, modification of contract. When there is modification of contract, change in scope, distinct product and the price standalone. You remember those 2 points, you remember. Change in scope, change in price is lease modification. You take revised rate. Estimate change, it will come to lease remeasurement. And in case of lease measurement, in two cases you take revised rate. One is lease term change and the other is purchase option change. Only two reasons plus one reason, lease modification, you go for revised rate. For everything else you go for original rate. Future lease payments changes because of index rates. Could you explain? Is it only say inflation index change? Yes, inflation change, LIBOR rate change, a population growth change. I mean, any index change, that is not change in lease payment. Lease, that is change in lease payment, but that is in lease reassessment, that is remeasurement, original rate. But new rate will come when there is price itself is changed, that is the scope change. You took additional building on rent or existing building you gave it away. Those cases lease modifications will come, and lease modifications is always revised rate. But if these index rate changes and all, it's not lease payment change as such, so original rates only will come. If inflation index and all, you take the original rate. Can I go further? Change in underlying asset is modification? Yes, change in asset. If asset itself is changed, definitely modification only. It's new asset, new contract altogether. If asset is changed, it's a new contract, definitely modification. Term also can change, no? A term reassess, term also can change. If 8-year was the lease term, then mutual agreement you brought down to 5 years. That is modification. But this is change in lease term because of these points. Reassessment points have come, some additional evidence have come, your thought have changed. Because of that, when those estimates change, that only remeasurement. If original contract is 10 years, now corona came, let's say we'll only go for 4 years, that is not remeasurement, that is lease modification. So don't think else other than this is remeasurement, don't think like that. If it has to be lease modification, scope should change. Scope means underlying asset as well as lease term as per the agreement, not expectation. Lease term as per the agreement or the lease payment as per the agreement. Let's say remember you three things: lease term as per lease agreement, lease payment as per lease agreement, underlying asset as per lease agreement. If one of these three changes, it is lease modification. As per lease agreement, payment as per agreement, lease term as per agreement, the underlying asset as per agreement. One of them changes, modification, else measurement. Estimates change, measurement. I hope you got the clarity now on this point. Lease modification, okay. Let us go to a problem quickly, my dear friends. Solution, again, don't write it down, I'll explain. Please read. Lessee enters into 10-year lease of 5,000 square meters. Annual lease payments are 1 lakh payable at the end of each year. Interest rate implicit cannot be determined. Lessee's incremental borrowing rate 6%. At the beginning of year 7, lessor and lessee agreed to amend the original lease by extending the contract lease term by 4 years. Okay, before you read further, can you tell me, my dear friends, is it lease modification or lease remeasurement? Agreed to amend the original lease. Is it lease modification or remeasurement? Can you tell me? Agreement change, modification. I hope you got the thumb rule right. But if the same problem they said, the lessee had option of 10-year plus 4 years renewal option. Earlier you thought renewal will not happen. Now lessee has changed his mind and he go for 4 years more. That would have become lease reassessment, remeasurement. The agreement itself is getting changed. Hope you are getting the fundamental concept clear. If it was a change in estimate, that would have been lease remeasurement. But this is fundamental change. Okay, I think many of you got it. Modification, I'm happy. Let's go further. Annual lease payments are unchanged. 1 lakh from the year 7 to 14. So annual lease payment no change. Less incremental borrowing rate is 7%. Can you tell me, will you use 6% or 7% here? 6% or 7% here for discounting for new liability at the beginning of year 7? Which one will you use? 6% or 7%? Okay, 7%. People are getting it. And if this problem was lease remeasurement, then 6% you would have used, or 7%. Lease term change, go back. If it was lease remeasurement, lease term change means you would have gone for revised rate only. But for these things, you would have gone for original rate. I hope your points is clear. Let me give you the solution now. Okay, now original lease liability beginning 10 years 1 lakh, 6% discounting rate 7,36,000. Now carrying amount of lease liability at the beginning of 7th year at the time of lease modification 1 lakh, remaining 4 years. See, 10 years was the thing. Out of 10 years 6 year is over, remaining 4 years. That's how I got remaining 4 years original 6%. I got 3,46,500. One more method is also there. Amortized cost method 7,36,000 plus 6% minus 1 lakh plus 6% minus 1 lakh plus 6% minus 1 lakh. Like that you can do for 6 years. Or you can do remaining cash flow present value. That is also fine. That's what I have done. Now lease modification, you go for it. Lease modification 1 lakh. Remaining 8 years, beginning of 7th year. So remaining 8 years, new rate 7%, 5,97,100. So difference between these two, you will debit ROU asset, and you will credit lease liability 2,50,600, 2,50,600. Modification always new rate, correct. I hope, don't write it down. Hope you got the point. Spend 2 minutes, read the solution. Tell me if you have any question. Actually, lease liability, this was not required. So this is present value of remaining payments for book value. This is present value of new payments for new amount, new carrying amount, new value. Difference, don't take it to P&L, adjust in ROU asset as well as ROU liability. Can we go further? Any questions? 3.465 is 7 to 10 years. This is 7th to 10th, but standing on 7th beginning, therefore remaining 1 to 4 years. 7 to 10, 3.465 is 7 to 10 years, but standing on 7th year. So standing on 7th year, 8, 9, standing at the beginning of 7th, 7th end, 8th end, 9th end, 10th end, mean remaining 1 to 4 years. Standing at the beginning of 7th, remaining 1 to 4 years. Okay, hope you got it. Five lakh 97,100 depreciate over remaining 8 years and interest on lease liability 7%. Yes, right. All prospective accounting, no retrospective accounting. Prospective depreciation, remaining useful life, and the new discounting rate, remaining term, contract term. No retrospective calculation. All prospective effect. Okay, let's go further. Lesser accounting, actually no change. As per AS 19, whatever is there, that continues. So you know there are two types. One is financial lease, other is operating lease. When substantial transfer of risk and reward takes place, financial lease. In all other cases, operating lease. So let's do one quick problem based on that. Question number 3. Ownership of an asset gets vested to lessee at the end of lease term. It is financing lease. Lessee has the option to purchase the asset at lower fair value than fair value at the end of lease term. Financial lease. Economic life is 5, but lease term is 4.5 years. Financial lease. Present value of MLP is X and fair value is Y. If present value is approximately same as Y, that is present value approximately same as fair value, then financial lease, else operating lease. Economic life is 5 years, lease is 2 years, asset is of special nature and procured only for use of lessee, this also financial lease. This is what you would have learned in IPCC also. Financial lease accounting, you know it. On commencement, existing book value is de-recognized and you are going to recognize that NIL, meaning what? Net investment in lease. And net investment means present value of cash flows, present value of GIL, gross investment. What does gross investment include? Lease payments and unguaranteed residual value, meaning guaranteed residual value anyway is there in the lease payment and unguaranteed residual value will be there. So you can say total residual value, lease payments. When you do present value, you get the present value, that is called as net investment in lease. And for manufacturer dealer, you recognize per Ind AS 115. And financial income like amortized cost basis, that you recognize financial income. Variable lease payment, directly take it to P&L account. Impairment, you apply under Ind AS 109. So for financial lease, you will apply Ind AS 109. It is classified like a financial asset. Same concepts will apply. Operating lease, you know, you will recognize on a straight line basis. On income is transferred, no asset is de-recognized. Operating lease, you recognize it on straight line basis. Simple one. Question number 4, quickly I'll show you the solution. Fair value of the machinery 20 lakh, lease term 5 years, lease rental 5, guaranteed residual value 1 lakh, expected residual value 2 lakh, internal rate of return 15%. So what is that? Annually 5 lakh, so 1 to 5 years, discounting rate 3.352. Last year, not guaranteed and guaranteed, total residual value 2 lakh, last year discounting factor you get, and sum it up, sum of these two you get 1770 lakh, and gross investment in lease 27 lakh, and difference between those two is called as unearned finance income. And how will you recognize over a period of time? The 17 lakh 75 will be opening balance plus financial income at 15%. So this plus financial income minus lease payment becomes a closing balance. That is how we discussed amortized cost. And like that happens over a period of years. Last year make it as a balancing figure, and that year last year the contract is over. And 9,24,600, which is unearned finance income at the beginning, is earned over a period of 5 years like this. This is a simple accounting from the point of view of lessor. Whatever you have learnt in AS 19 applies for lessor as it is. Okay, sublease. Sublease means there are three parties. So one party, lessee, he will take the asset and he will give the asset. So he is a lessee and he is a lessor. He is both the parties. So as a lessee, he will recognize lease liability and recognize ROU asset. Lessor, as a lessor, you can have two possibilities, either a financial lease or a operating lease. If it is operating lease, ROU asset continues. If it is financial lease, ROU asset is replaced by net investment in lease. That is a simple concept of sublease actually. You only have to think from the middleman point of view. He takes the lease and he gives the lease. He is a lessee in first contract, lessor in second contract. Being a lessee, lease liability you recognize and ROU asset you recognize. Lessor, it can be two types, either a financial lease or a operating lease. If it is a operating lease, ROU asset continued. If it is a financial lease, then ROU asset will be taken out because you are not controlling it, you are not using it, therefore ROU asset is taken out. Instead, it will be replaced by the net investment in lease. Difference will be transferred to P&L account. Expected guarantee includes guarantee lessee. Yes, all guaranteed by lessee, his related party, or any outsider guarantee, and unguaranteed, meaning total residual value for lessor. Okay, so this is about sublease. Quickly, I'll spend 5 minutes on sale and lease back. Sale and lease back, where you sell the asset and you take it on lease. So what you should do? You should check whether it is satisfying as per Ind AS 115 or not. Only if it is satisfying Ind AS 115, then you recognize it as sale and lease back. If Ind AS 115 is not satisfied, this will become a financial rearrangement, asset taking and taking it back. So difference will become a loan or an asset. Then once you take the asset as lease back, you have to check whether it is greater than fair value terms or lesser than fair value terms. If it is greater than fair value terms on a lower terms, what do you treat? The difference will be treated as lease payment. And if it is higher lease term, that means you get more money. Why will you get more money? Like a loan taking. You are taking a loan. Therefore, you treat it like a loan received. And on the sale and lease back, there's one beautiful question which I have solved. in my videos, eight session videos towards the end, last session or last but one session, one beautiful problem is there. You can watch it there. You'll get a good clarity on sale and leaseback. Then transition approach. This is very theoretical. I don't think they'll ask you a question. So practical experience is there. If there are no existing leases, then you need only for that you need to do no retrospective calculations required. For old leases, you can ignore it. Then for lessor and lessee, for lessor no change continues. For lessee, you have two approaches: full retrospective approach or modified retrospective approach. Modified retrospective, full retrospective means you go for it from the beginning, prepare 3 balance sheets and all. And modified retrospective approach means don't change anything beyond, give the cumulative effect only in the opening balance and give comparative opening balance and current year. And modified retrospective means don't go for cumulative change also, remaining cash flows are there and remaining time period you account for lease liability. Actually, retrospective approach is not a good name because we are giving prospective effect, but institute has given that name, so we are also giving that name. Okay, so this is our Ind AS 115 and 116. Ind AS 116, if you want more clarity, I have done problem on this also and sale and lease back also. It's available on the YouTube free. You can search and do the problem based on that. Okay, so this is what we wanted to do. We have achieved. So major areas, I would say 60% of the examination we have covered. Consolidation, business combination, share-based payments, financial instruments, Ind AS 115, Ind AS 116. I think 60 marks will come from this. If you are master of these areas, you pass the exam. I think you can think like that. So remaining standards are there. Quickly we'll summarize. Ind AS 7 cash flow statement under consolidation I'm going to solve. Then as usual, Ind AS 12 is there, Ind AS 21 is there, all small standards. Ind AS 16 is a quite big standard, important impairment. So those things are pending. Those things will take it up in the next set of sessions. So as of now, any doubts you have anything, get it clarified. As usual, in some time today, I'll share the MCQ on these Ind AS 115, 116. You can write it. You test upon guarantee accounting being financial liability. Financial liability you don't account as long as it's a contingent liability, because contingent consideration are classified as financial liability but not taken into books of accounts unless it is required that the default happens or default likely to happen. Till then you continue show it as contingent liability, but financial liability measurement principle would apply. How many days class remaining? I'm trying to finish it in remaining maybe 3 days, maximum 4 days. 6, 7, 8. That is my target. As a reserve, I've taken as 9. So 6, 7, 8 is my target. 1 extra day might happen, not beyond that. So 3 plus 1 you can say. Yeah, moving assets like Ind AS 16 to 3, this is yes, it will be tomorrow, correct. Property, equipment, impairment and all will be tomorrow, correct. Will you provide MCQ for all the thing? I'll try my level best. I am not guaranteeing it because I need to write down the solution. So whichever important solutions you require, a discussion happening on the group, I will reply to that. And some of good students are there, they are also replying it. So if you have any doubts, you're not able to get the answer, please raise the question in the Telegram group. It's a very good technology. People will answer it. If people are not answering, other students are not answering, I will answer it. So if you have any doubt, please get it clarified in the group. For this next 2 months, I'm slightly tied up. I may not be able to get the answers in detail for each question. I don't guaranteeing it because my regular class is also coming up. I'm preparing for that. Over a period of time, I'll provide solution, but not for this attempt. If you have any doubt, in the group you can get it clarified. Okay, so today I think internet gave a good support. So pray well for next 3-4 days that internet works well for us. So that's it for today. Hope you are spending your valuable time. I know it's free session, but still you're spending your time. I have to respect that. Hope you are learning something really valuable for examination. Only thing which I expect in return is your good marks in exam. And once exam is over, you can please send a message telling it was useful. Tomorrow onwards, old syllabus students also can attend. Yes, I will tell you the differences. Old syllabus also can attend, especially PPE, intangible assets, impairment. Old syllabus also is very, very important. Okay, good. So all the best. Read well. Happy learning. We'll see you tomorrow at same time, 10:45. Thank you. See you all.